What is book value? Book value is the total value of a company's assets minus its liabilities as recorded on its balance sheet. In simple terms, it's what the company would be worth if it sold everything it owned and paid off everything it owed. Think of it as the company's net worth on paper. You'll usually find book value listed in company annual reports, balance sheets, and on many investing platforms. Why does it matter? Book value matters because it gives investors a grounded idea of what a company is worth based on its actual assets, not just on market opinion. The key difference is this: book value is what the company is worth on paper, while market value is what investors think it's worth in the stock market. For investors, this comparison can be useful. If a company's shares trade far below its book value, it might look like a bargain. If they trade far above, it might signal high expectations for future growth. Value investors in particular often hunt for companies trading near or below book value because they see them as potential opportunities. Here's a simple example. Imagine a small company that owns £10 million worth of assets, things like property, equipment, and cash. It also has £4 million in debts. If you subtract the debts from the assets, you're left with £6 million. That £6 million is the company's book value. Now, if the company has 1 million shares in circulation, then the book value per share would be £6. If those shares are trading in the stock market at £12, it means investors are willing to pay double the book value, possibly because they believe the company will grow and make more profits in the future. What else should you know? Book value isn't perfect. Not all assets are easy to measure, and things like brand reputation, patents, or customer loyalty don't show up clearly on the balance sheet. This is why book value tends to be more useful in asset-heavy industries like banks, insurers, or manufacturers, where physical assets dominate. For tech firms or service companies, much of the value is tied up in intangible things like software or brand strength, which book value doesn't capture well. It's also important to note that a share trading below book value isn't automatically a bargain. It could be a sign that the company is in trouble or that its assets aren't as valuable as they look on paper. That's why investors often use book value alongside other measures like earnings, dividends, or cash flow to build a fuller picture of a company. To sum it all up, book value is the net worth of a company based on its assets and debts. It's a useful reality check against the market price, and especially handy for comparing companies in asset-heavy industries. But it doesn't capture everything, and for many businesses, the real value lies beyond the balance sheet. For investors, book value works best as one piece of the puzzle, not the final answer. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.